To be a successful trader in the crypto space, you need to know the best time to buy. So here are 10 bullish crypto signals to look out for. Number 10, the falling wedge. A falling wedge is a chart pattern formed from two downward and diagonal trend lines, though not in parallel, drawn above and below the price action of an asset. Though falling wedges are representative of the price action being in a downtrend with a series of lower highs and lower lows, there remains a 70% chance of a move to the upside at some point, usually when the asset descends far enough to reach a long-term support line and buyers begin to regain control. So planning a long trade around the break of a falling wedge's upper resistance line can reap tremendous rewards. And this is what it looks like in the real world. Here's your two diagonal trend lines, one acting as support and the upper acting as resistance. And finally, when buyers take control, a breakout occurs and upwards we go. Number 9, the double bottom. A double bottom is a reversal pattern that can be observed at the bottom of a downtrend and signals an impending reversal in the price action. It forms after an asset puts in two consecutive lows with a moderate increase in between each one. It is confirmed once the asset's price rises above the resistance level equal to the high between the two lows. And this is what it looks like on a real chart. We have a downtrend and then the first bottom with a bounce forming the peak, which equals the resistance level, and then the second bottom, and then finally the breakout of the resistance line, and upwards we go. Number 8, the golden cross. A golden cross is a basic technical indicator that occurs when an asset's short-term moving average, such as the 50-day, rises above a long-term moving average, such as the 200. When traders see a golden cross occur, they view it as indicative of a strong bull market and an excellent place to enter for a long trade. Hidden in this video is a Bitcoin. It's not the one in the bottom corner. If you manage to find it, let us know in the comments, and hopefully this bull run I'll be able to help you find many more. Now back to the list. Number 7, the ascending triangle. An ascending triangle is a bullish chart pattern characterized by an ascending lower trend line and a second, flatter horizontal resistance line. An ascending triangle is commonly considered a bullish chart pattern or a continuation pattern within an uptrend. The horizontal line represents resistance that initially prevents the security from moving higher. Imagine a large sell order has been placed around this level and it takes a number of weeks or months to fill, preventing the price from rising further. And even though the price doesn't ascend past this level initially, the reactionary lows continue to lessen. It's these higher lows in the price action that indicate increased buying pressure and give the ascending triangle its bullish bias. Eventually, the upper resistance line breaks, and that's your signal to buy, as the price is likely to ascend further. And this is what it looks like on a real chart. We have the resistance line, then we have the higher lows, and finally the breakout, which equals higher prices. Number 6, bullish divergence. Bullish divergence, regular or hidden, provides bullish signals that help identify potential trend reversals in the price action of an asset. It involves comparing the price action with an oscillator, such as the relative strength index, and occurs when the asset's price and oscillator move in opposite directions. Divergence is one of the more challenging indications to spot, but it's as close to having a crystal ball as you can get. Bullish divergence involves drawing a line across the bottom of the price action and the bottom of the oscillator swings, whereas identifying bearish divergence requires the exact opposite, with lines drawn across the top. And this is what it looks like on a real price chart. The price action is making lower lows, and then the relative strength index is making higher lows, creating a divergence in the trend, and then upwards we go. If you're willing to put in the time to get to know this market and develop your skills, you can achieve percentage gains like these. I will be routinely breaking down successful trades and highlighting my decision-making process for each one. No hot air or bluster here, just the cool breeze of a strategy that works. If this content is for you, please consider subscribing. Number 5, an oversold RSI. The relative strength index, the RSI, provides clear signals for when an asset is either oversold, bullish, or overbought, bearish. The RSI oscillates between 0 and 100 and is considered oversold when below 30 and overbought when above 70. When the RSI reaches oversold conditions below 30, it can serve as a simple yet effective indication that the price action is likely to reverse and begin moving higher. Used in conjunction with other bullish indications, it can be a helpful tool to assess when to enter a long trade or when to close a short position, should you be one of the bears. And this is what it looks like on a real price chart. The price action is in a downtrend, but when we reach oversold conditions on the RSI below 30, we get a nice bounce out of the price action and upwards we go. Number 4, the bull flag. Bull flags are found within a strong uptrend and are considered continuation patterns for the price action. They are called bull flags because the pattern resembles a flag on a pole. The pole is the result of the vertical rise of an asset's price preceding the flag, and the flag results from a period of consolidation where buyers essentially catch their breath following a strong rally. The flag can be a horizontal rectangle, but is also often angled down away from the prevailing trend, like in this example. The shape of the flag is not as important as the underlying psychology behind the pattern. Basically, despite a strong vertical rally preceding the flag, the stock refuses to drop appreciably as traders see the consolidation period as an opportunity to enter the market before an asset continues higher. The breakout from a flag, as you can see here, often results in another strong upwards move. Bull flags typically begin to surface in conjunction with a new market rally, so definitely something you want to be looking out for this bull cycle. Number 3, the bull pennant. The bull pennant, like a bull flag, is a bullish continuation pattern that signals the extension of an uptrend after a period of consolidation is over. It resembles a symmetrical triangle, and unlike the flag where the price action consolidates within two parallel lines, the pennant uses two converging lines for consolidation until the breakout occurs. Pennants have a slightly lesser probability of an upside break compared to bull flags, but the advantage pennants have is that their converging lines afford traders a definable point when the pattern completes, making it easier to assess the likelihood of a breakout and a move higher. And this is what it looks like in the real world. We have our two converging diagonal trend lines forming a symmetrical triangle, and then the breakout occurs once the resistance level breaks, and upwards we go. Number 2, the inverse head and shoulders. An inverse head and shoulders pattern is a specific chart formation that predicts a bearish to bullish trend reversal. It is similar to the bearish head and shoulders pattern, except that it is inverted. The pattern appears as a neckline with 3 troughs, with the outside 2 being the closest in height and the middle being the highest. The inverse head and shoulders pattern is considered one of the most reliable trend reversal patterns out there. It is one of several patterns that signal with varying degrees of accuracy that the downtrend is nearing its end. And this is what it looks like on a real chart. We have the resistance level or neckline here, the left shoulder and the right shoulder at around the same height, and then the taller head. And then finally, when we have a break of the resistance level or neckline, upwards we go. And finally, number 1, the bullish retest. A bullish retest is a confirmation signal that indicates to traders that a key trend line has been flipped from resistance to support. The bullish retest can be used as final confirmation following the breakout of a pattern or trend line that the price action is likely to head higher. And even though some traders will open long trades or exit their short positions based on the very first sign of a bullish break above key resistance, the bullish retest affords the price action the chance to reverse back into the pattern first or back below previous resistance following its breakout before traders choose to react. But if sellers aren't able to push the price down and the price action remains above previous resistance, that signals to traders it's now appropriate to enter their long positions. The advantage of waiting for bullish retests to occur is that they help traders avoid potential bull traps, where the price action moves above a key resistance line or out of a pattern and then quickly heads back down, catching buyers out with a fake move or a fake out. Most of the other bullish signals on this list work really well when paired with the bullish retest, with the retest confirmed once it's clear the price action isn't going to descend back below the breakout level. Here is what the retest looks like when paired with some of the other bullish signals and patterns we've looked at today. This is the bull flag we were looking at earlier, and once the price action breaks out of the key resistance level, you'll notice it comes back down to retest the resistance line to confirm it has flipped from resistance to support, and then upwards we go. This is the bullish pennant, the symmetrical triangle, and again, as you can see here, once the price action manages to break above resistance, the price action briefly recedes to confirm that this level has been flipped from resistance to support, and then the price action continues higher, with the retest providing an excellent entry point for long traders. This is the double bottom. We have bottom 1 and bottom 2, and then the resistance level formed by the peak in the middle. And then finally we have the breakout and the eventual retest, which is where this previous resistance line flips to support. And this is what the retest looks like on the falling wedge. You can see here we've got our two descending diagonal trend lines acting as support and resistance, and the second resistance breaks, we have a move upwards and then a decline in the price action, so traders can confirm that this level is no longer acting as resistance but is acting as support. Again, long traders will jump in here. This is the inverse head and shoulders, and if you were looking to enter a long trade here following the reversal in the trend, you would wait of course for the left shoulder to form, the head and the right shoulder, and once we get the breakout of the neckline or the resistance level, you wait for the price action to come back down, and once it retests the previous resistance level and doesn't recede further, that is your entrance point for a long trade. And finally, this is the ascending triangle we were also looking at earlier, with this rising diagonal trend line acting as support for these higher lows in the price action, and this horizontal line acting as resistance. And when the resistance line finally breaks, you can see the price action breaks out briefly before coming back down to perform a retest to confirm that this pattern, or rather this resistance line, has flipped from resistance to support, and then away we go. That's it for now. This has been 10 bullish crypto signals. If you like the content I provide, don't forget to hit the subscribe button. We also have a trading group you can join. Links in the description. Catch you in the next one.